Welcome to the Small Business Tax Savings Podcast, powered by Jetro. Each week, we bring extremely valuable accounting and tax tips specific to small business owners. You will be on your way to growing your business and putting more money in your pockets. Here's your host.
Hello and welcome back to another episode. Today's topic is, what are estimated taxes and how do I pay them? Now, before we get into that, this episode is brought to you by the Tax Minimization Program, which is a training program to ensure that you pay the least amount in taxes as legally possible while also having a solid bookkeeping foundation. As part of our program, you also have access to our team for general tax and accounting questions. It is like having an accountant in your back pocket with you on this entrepreneurial journey. Learn more at taxsavingspodcast.com/tax. I am your host, Mike Jesowshek, and again, today's topic is, what are estimated taxes and how do I pay them? And this is actually the 8th episode in our Starting a Business series, and what we've been talking about is that this series stemmed based on a conversation I had with a new business owner that just had no idea what steps they needed to do. So we talked about this in our free Facebook group and decided that doing an entire series on topics that new business owners need to know and understand would be important, and that is where this stemmed from. If you are not part of our free Facebook group, join now. Go to Facebook and just type in Small Business Tax Secrets. There'll be a few questions that you have to answer to get in, and then we'll let you in there where we talk about and you can collaborate with other business owners. So today's topic about estimated taxes is one that I'm excited about because so many business owners run into this exact question, and there's often so much confusion about it. So the first question I want to talk about is, when do you owe taxes on your earnings? And now, the U.S. tax system is a pay-as-you-go system, and what this basically means is that as you earn money, you owe taxes on it. So kind of as we talked about a couple weeks ago, this is one area that really confuses people. So basically what this means is that if you make, let's just say $85,000 in quarter one of the year, you do not have until you file your tax return to pay the taxes on that. You'll pay taxes or owe taxes on that as you are earning that money. So to help us understand this a little better, let's look at this as a W-2 earner. So let's imagine that you're working for somebody else. And let's just picture that you're a highly compensated W-2 employee earning $340,000 a year. Now that's $85,000 per quarter. And then as you get your paycheck every other week, your employer is going to pull all sorts of taxes out of it. There's going to be federal withholding, there's going to be state withholding, and there's going to be FICA taxes, which is Social Security and Medicare. So in this scenario, you are paying taxes as you earn the money. Your employer is just calculating that and paying it for you. So even though you're making $85,000 a quarter or $340,000 a year, getting paid bi-weekly or whatever your pay schedule is, you're not actually receiving all of that money because your employer is withholding taxes on your behalf and paying them in for you and calculating and paying those for you. So you are paying taxes as you're earning it. Now let's flip the switch. You're a new business owner and you made in quarter one of the year $85,000. You have no employer. You are your own boss, and you are the one that's responsible for paying taxes on those as you earn it throughout the year. Note, if you're an S corporation and taking a salary, you are going to be paying taxes on that salary portion throughout the year through a payroll software. But as you take distributions, those amounts you obviously would not be paying taxes for and would be responsible for those estimated taxes. And this is really where estimated taxes come in. Estimated taxes are a vehicle to pay taxes into both the federal and state government agencies on a quarterly basis to cover the amount that you earn or that you expect to earn. So how does, one thing that comes about this is, how does the year-end tax return play into all this? Now, your year-end tax return is simply a reconciliation of what you earned, what you paid, and then reporting all of that information to the government agencies. That's exactly what a tax return is, and we talk about that a lot during tax planning. A tax return is simply a reconciliation of what you earned, what you paid, and then sending that to the government agencies. So based on that report or that tax return, you will either receive a refund or you're going to owe taxes into the government. And a refund simply means that you paid too much in taxes throughout the year, and the government is just giving you that money back to you. An amount owed or amount due is when you're filing simply means that you did not pay enough in taxes throughout the year, and now you need to cover the rest of your tax bill. There is potential that you might have some interest and penalties if you end up owing taxes at year end. And that is it. The year-end tax return is simply sending information to the government agencies that tells them what you earned throughout the year and any payments you made, and then you either get a refund if you overpaid or there's going to be an amount due if you haven't paid enough. So let's talk about estimated taxes. When are estimated taxes due? And they're going to be broken down into 4 quarters. Now, I'm going to warn you ahead of time. These quarters are not your typical quarters. So typically the quarter is going to be 3 months. When we talk about estimated taxes, it's not necessarily going to be that way. Quarter 1 is January through March. So that's typical. January through March earnings, that estimated tax payment is due April 15th. Quarter 2 is April and May only. So 2 months, April and May earnings, and that is due June 15th. Quarter 3 is June through August earnings, and that's going to be due September 15th. And then quarter 4 is September through December earnings, and that's due January 15th. So for whatever reason, when it comes to estimated taxes for the IRS, they do not recognize the normal quarters. So you may be thinking that we made a mistake on that, and that's why I wanted to assure you that those are accurate. Again, quarter 1 is January through March, due April 15th. Quarter 2 is April and May, due June 15th. Quarter 3 is June, July, and August, or June through August, due September 15th. And quarter 4 is September, October, November, and December, or September through December, due January 15th. Now let's talk about how we calculate estimated taxes, because this is probably one of the biggest questions we have when we talk about estimated taxes is what amounts do I do? And really the IRS has given us a couple options when we're determining how much should we send in. They have what we call the safe harbor method. And the IRS's safe harbor method basically means that if you pay a certain amount of dollars in via quarterly estimates, you're not going to owe any interest and penalties at year end, even if you underpaid. So they call this a safe harbor. If you make this minimum amount of payments in, then you're not going to have to owe interest and penalties. You might have a tax bill still at year end, but you're not going to owe penalties on that. So when we talk about the safe harbor, there's a couple options. Option number 1 is that you pay 100% of your tax liability for the previous year via estimated quarterly tax payments. So that's 100% of your previous year tax liability. You had a tax liability last year of $10,000. You pay 100% of that this year. You will not get hit with a penalty. Now, one thing to note is that if you have an adjusted gross income over $150,000, then that number moves to 110% of your tax liability for the previous year. So let's say use that same example: tax liability of $10,000, but you're over that $150,000 mark in adjusted gross income. Now you'd have to pay an $11,000 estimated tax payments throughout the year evenly to avoid that penalty. The other option is to pay 90% of your actual tax liability for the current year. And again, that's to ensure that you do not get hit with penalties. So let's imagine that last year you earned $50,000. And this year you won the lottery, or you had a really good business year and you made $1 million this year. If you make that minimum required estimated tax payment, even though you still owe a ton more this year, you will not be faced with any interest or penalty. Now, one thing to know is that you still owe the taxes at year end. You're just going to not have to fork more over in interest or penalties for that. So again, one option is pay 100% of your tax liability for the previous year via estimated quarterly tax payments. If you have an AGI over 150, then that number moves to 110% of your tax liability for the previous year, or pay 90% of your actual tax liability for the current year. So the safe harbor method is by far the easiest method and recommended for those that have consistent income. So that 100% or 110% is what we recommend for those that just have a pretty consistent income, not much changes. If you have big swings in income, this method could leave you with a surprise bill at year end. So let's say you have little income last year, but big income this year. You might avoid penalty, but you're going to be hit with a big surprise at year end with a big tax bill. Or vice versa. Let's say last year you had a lot of income, but this year it's way down. If you use the 110 method, you probably are 110% method, you're going to be likely overpaying, which just means you'll get a refund at year end. So that's one method, is the safe harbor method. The second method is the actual method. And this method is where you take your actual business income and other earnings that are occurring throughout the year and then run the numbers on it as if you're kind of doing like a mini tax return to get a pretty good idea of what your tax will be based on those actual numbers that you're using. Now, this method is a little more difficult and can be time consuming, but it's going to be the most accurate as you're using live data instead of kind of just basing it off a prior year activity. Now, I've looked around the internet and just have not been able to find a perfect calculator for this, but I did find two possible options to use. One is more of a simplified version and one is more of a detailed version. So in the show notes, we have a link to our blog post on this topic. Check out the links to those two calculators if you want to try running some numbers and using the actual method. Just be sure that you run these numbers or these results past your tax preparer if you want some verification on it. So again, that's the actual method. Now, what happens if I do not pay estimated taxes or I severely underpay estimated taxes? If you do not pay enough taxes throughout the year, either through withholding, through like a paycheck, a W-2, or estimated taxes, you may have a penalty for underpayment of estimated taxes. Now, remember, we talked about a way to avoid that penalty via the safe harbor method. But if we don't utilize that safe harbor method, the amount of the penalty or interest is simply going to depend on how late you are. But it's typically calculated based on 0.5% of the amount that you owe each month you're late, up to a maximum of 25%. So, how do I pay estimated taxes? You can pay estimated taxes to the IRS online or via check. And so on the blog post for this topic, we also have links to where you can make payments online, as well as a link to grab some estimated tax vouchers. Typically, we're going to say go online because if you're sending a check in, you never know when that check's going to be cashed. So we're typically going to recommend you making those payments online. There is a link there. For your state, you're going to want to check on your specific state on their website to see kind of what payment options are available. I would say majority, if not all of states, do have online payment options. So again, let's kind of recap what we talked about when we're thinking about estimated taxes. And again, this is important for new small business owners. The U.S. tax system is a pay-as-you-go system, which basically means that as you earn money, you owe taxes on it. So even though we're filing a tax return at the end of the year, we owe taxes on that money as we are earning it throughout the year. And I would like to give this an example. Think of when you were a W-2 employee. You had taxes withheld from your paycheck as you earned the money. That was done by your employer. Now that you're a business owner, you don't have anybody withholding those taxes for you, and that's where estimated taxes come into play. So the end of your tax return is simply sending information off to the government agencies that tells them what you've earned throughout the year and any payments that you made against that, which then comes to a refund if you overpaid or an amount due if there's still tax payments that need to be made. Estimated taxes are sent in quarterly. Now, those quarters are a little different than typical, though. Quarter 1 is January through March, and that's due April 15th. Quarter 2 is April and May, and that's due June 15th. Quarter 3 is June through August. That's due September 15th, and quarter 4 is September through December. That's due January 15th. When we're looking to calculate tax or estimated taxes, there's kind of two methods. The safe harbor method, which is basically just saying we're going to pay the minimum amount due to avoid any kind of interest and penalties. This is the easiest method to do. If you have very similar income year to year, this is also going to be probably the most recommended one for you. Basically, to avoid penalties or interest, you need to pay one of two options. Pay 100% of your tax liability for the prior year. You're going to pay those via estimated quarterly tax payments. Or if your adjusted gross income is over $150,000, then you're going to pay 110% of your tax liability for the prior year. The other option is pay 90% of your tax liability of the current year. And that kind of plays into our second option for calculating estimated taxes. That's the actual method. And this is where we're going to take your actual business income, your actual earnings, run it through a calculator, kind of do a mini tax return to see what we predict your estimated taxes are going to be, and then make payments based on that. If you do not pay estimated taxes, you're going to get hit and you have an amount due, you're likely going to get hit with a penalty unless you did one of the safe harbor options, that 100% of the previous year tax liability or 110% if your AGI is over 150. That penalty is going to be 0.5% of the amount that you owe for each month that you're late. You can pay estimated taxes online or via check. when it comes to the IRS, and you're also going to want to check with your state side to see kind of what options are available there. So hopefully this was helpful, and now you can kind of be on top of paying your estimated taxes, avoiding any penalty, and just feel comfortable knowing that you're kind of taking care of this piece in your business. As always, we talked about, what percentage should I put away? That's also a good method. If you're making money, we say that 30% number, and it's a very, very rough number, but a 30% number can be a rough idea of what to put away. That's also, you can just base your estimates based on that if you chose to. So hopefully this was helpful. We're going to continue this discussion about our starting a business series. So as new business owners are coming alive, we want to have them go through a series where they know the different things that they want to make sure they're setting up and doing correctly right from the beginning. So we're going to continue this discussion. Join our free Facebook group. Again, it's just Small Business Tax Secrets directly on Facebook. Ask questions in there, collaborate with other business owners that are going through the same entrepreneurial journey as you are. And finally, I highly recommend that if you're listening to this and this is really relevant to you, that you sign up for our tax minimization program, which also includes our stress-free bookkeeping training. Not only are you going to get a bunch of in-depth training, templates, monthly group coaching, but you're also going to have unlimited access to our team for general tax and accounting questions. Now, how sweet would it be to have an accounting professional by your side for those questions that pop up while you're going along this crazy journey of being an entrepreneur, being a business owner? So check out our tax minimization program. That's taxsavingspodcast.com/tax. I want to thank you for listening to another episode. We have a really cool episode coming up in a couple weeks where we have a guest on that you guys are going to absolutely love. So be sure to tune in each week, and I will see you next week.
This has been another episode of the Small Business Tax Savings Podcast from the team at Jetro. If you enjoy our weekly episodes, please leave a review on whatever platform you listen to us on and share with other business owners. If you have any questions or future topics you want to hear, email them to tax@jetrotax.com. Thanks for listening and have a great day.